Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today, we're here with a topic of Michael's. Michael, what do you got?
The topic today is that I don't think there's anything wrong with a 50% drop. And what got me thinking about this is I actually had a phone call from a client of mine. And look, he's a really switched on, intelligent guy, this guy. And he said over the phone, he said, do we have the ability to move my superannuation into gold if I wanted to? And I said, possibly.
In theory, yes, we can do anything.
And after a bit of toing and froing, I said, where's this coming from? And he said, look, I just wanted to know if there was a big drop of 50%, 40%, could I actually move my superannuation and retirement savings into gold? And I said, look, I think what you're asking me, is there any way to protect against this, or should we be protecting against this? And then I said over the phone, I don't think there's anything wrong with a 50% drop. And then I just shut up.
Yeah.
And 3 or 4 seconds elapsed, and my client said, yeah, you're right. And we went on talking about how these are naturally occurring things. So it got me to thinking, I thought this would be a good topic for a podcast. Yeah. I just wanted us to let that resonate. I don't think
there's anything wrong with a 50%.
That there is anything at all wrong with a 50% drop. I don't think that. I think well, I know it to be a naturally occurring thing.
It is going to happen. Yeah.
It is going to happen.
Yep.
Further to that, we're not going to try and protect against that.
Yep.
For our clients, the investment philosophy that we have for our clients is we're accepting of these drops. We know that the only way that in the last 30 years, and we've done that, the returns of the last 30 years, so through all of those drops, including almost halfway through that period of time, the largest drop ever, 57%, global financial crisis of 2008-09. So from 1992 to 2022, I know through all of that, if I'd just simply been invested in the best, not the best, the largest companies in Australia and around the world, I would have averaged rates of return north of 10% over that period of time. And that's measuring all of those drops, including right in the middle of that period of time, the big one.
Yep.
A minus 57% drop, global financial crisis. So recognize that a part of getting a 8% or higher rate of return, part of getting that is not only accepting, it's embracing.
Yep.
It's embracing the knowledge that a drop of 50% or 57%, not if will happen, when will happen, and when it will happen again after that. Part of that is embracing that. Returns of north of 8% just do not exist.
Cannot happen.
Of a guaranteed nature without that volatility.
Yep.
The current guaranteed rate of return is 0.35%.
Yep.
It's a 1-year term deposit rate. So if I lock into that on the 1st of January, I know with assurance that I'm getting a guaranteed rate of return.
Yep. For a year. Now, there's no chance that rate of return will go negative. So what always happens is that guaranteed rates of return, of which term deposits are the closest thing we have to a guarantee over that period of time. Forgetting about the volatility between different periods of time of interest rate periods, but over that period of time,
A term deposit is the closest thing we have to a guaranteed rate of return. That rate of return is always going to be less, always going to be less over time.
It has to be.
On average, than something that's more volatile.
Yeah.
So the volatile nature of these great quality companies, it just doesn't go without. Like you cannot have great returns without volatility. It just does not exist. So again, I come back to I'm ranting here.
No,
but I come back to it. My position is I don't think there's anything wrong with a 50% drop.
Yep.
Not going to try to protect against that. Not going to try and time it. I might try and round up money down, not at the bottom because no one can pick that.
Yeah.
I may try and double my contribution rate. I might try and go lean on my cash because I want to invest it when things are 20, 30, 40% down. But I'm not going to protect against that. Not at all. I'm not going to try and move my investments. I'm going to try to change my investment strategy. I'm not going to go to cash. I'm not going to try and predict. I'm not going to try and do any of that. I just don't think there's anything wrong with a 50% drop.
Michael, this is one of those podcasts where sometimes when the other one suggests something, we kind of sit here and go, all right, mate, you're on your own. You've got nothing to add here.
Yeah.
I think it's always a good sign of a topic that is of interest that I'm sitting here in the background furiously scrambling, writing my notes as to my thoughts in response to this, because I didn't want to interrupt your flow of eloquence there and your rant about this. So I have 5 separate thoughts in response to this that I've just written down. So number one, I couldn't agree more. There's nothing wrong with a 50% drop. That, as you said, there's nothing wrong with it. That is a naturally occurring part of things. If I could invest in a way where I got that higher long-term return without the volatility, why would I do anything else?
Yes.
By its nature, I must be having to accept volatility in order to get the higher return. There is no way that there is an asset class that returns more without the volatility. Otherwise, that's all we would all own. That would be it. There would be no other planning required.
Yep.
That's point one. Point two. Again, couldn't agree more. There's no way to protect against that. There is no way to protect. And it's really interesting that you said the gold thing, which is the minute someone starts talking about gold, I find it fascinating because it's implied that there is some safe harbor out there. Or there is some way to either, there's some other asset class that I can switch into that will make me feel safe and secure and will get me through to the other side, which ties me to point 3 and 4 here, which is that if there is some safe harbour, it's got to be cash or term deposits because it can't be gold because gold by its nature, any other asset that fluctuates in price, it can't be the safe harbour because it's also volatile. So I never understand how gold could be the safe harbour because I could easily just buy gold and it goes down. So if I'm choosing to get out of one volatile asset class into another one, that makes no sense to me. I could be forgiven for thinking that getting out of one volatile, high-returning asset class like high-quality companies and getting into cash is a way to protect against that 50% drop. If I didn't think that, if I thought there was something wrong with it, and I thought there was a way to protect it, that's what I'd be doing. Point 3 here is that protecting it after the fact is pointless. So the comment of, if my super was to drop by 50%, can I move it? Well, the horse is bolted. Like there's no point moving after you. There's no point moving into something else after that 50% drop.
No.
So if you did think I can protect against that, or I need to protect against that, or there is a way to do it, you wouldn't do it after the 50% drop. Surely you'd do it before, which leads me to point 4, which is that protecting before that drop, it costs too much. What I mean by that is that the only way to avoid that big drop is to just own cash, and you can't do that. It costs too much. It costs too much in terms of the opportunity cost. It costs too much in terms of the returns that you are giving up in order to hold that much cash and to protect against that 50% drop. And then point 5, which is that not only is there nothing wrong with it, not only is there no way to protect. Protecting after the 50% drop is pointless. Protecting before the 50% drop costs too much. But number 5, if you're listening to this podcast and you're still working, you're a buyer, not a seller. So if even if all those things are the case, if you are accumulating for your retirement and the price of those assets that you want to own in retirement drops by 50%, how could that be anything but a good thing? if I know that I need to own, a large amount of companies to pay me dividends and to provide me the return that I need, and so that I can sell in the long-term future to fund my retirement income needs, how would a 50% drop be anything but a chance for me to accumulate more shares in those companies for the same amount of spare cash that I've got, that I'm salary sacrificing and I'm saving every fortnight?
Look, Dallas, you're spot on there, because you're right. If you're still working, you're a net purchaser of these items. So a net purchase, what we mean by that is that you're buying every fortnight. Yeah. You're buying, you're not selling.
Why would you want the price to go up?
We've said before, you buy when you have the cash.
Yep.
Disposable.
Yep.
You sell when you need the money.
Yep.
While you're working, every fortnight that you get paid, you're a net purchaser of these things. You would want a 50% drop.
Yes.
You're right.
Yeah. And
do you change anything at that point in time? Well, the only thing you do, if you can, is you double your contribution rate.
Yeah.
Things like that. Because you go, okay, well, at some stage in the future, when I need the cash, when I'm retired, I'll get to sell some of these items for prices that we'll never see again.
Yes.
If we're working on historical perspective.
Yeah.
And so I love all of those points.
Yeah.
When it comes down to your position as a focused, patient, planning, disciplined investor, there's nothing to protect against.
Yep.
Because the 30-year returns with the global financial crisis in there and countless other bear markets, those returns have been north of 10% per annum over that period of time. So what is there? What actually is there to protect for the patient, disciplined, planning focused investor?
Yep.
For me, there is nothing to protect.
No.
So that's my new position.
Yep. I think that's a great...
I don't think there's anything wrong with a 50% drop.
I think that's a great way to think about it, because those points that I've touched on there, I think we like all financial planners and like all people looking at this, are guilty of taking a point that someone makes, which is, a client comes to us with a concern or a question or a query. We're all guilty of dealing with that in the framework in which it comes to us, if that makes sense.
Yeah, I know.
So someone comes and says, a 50% drop is something to avoid. And we immediately get to work on, okay, how do we discuss it as though it's a necessary, it's bad, but here's what we have to bear in mind. Or it's bad, but here's how we allow for that. And it's bad, but here's how we take advantage of that. It's a different framework to look at it through the point of view of there's nothing wrong with a 50% drop. Now, there is planning work that needs to be done as it relates to your retirement going, I'm invested predominantly in these assets that I know will drop by 50% at some stage throughout my retirement. Where am I going to draw my income from so that I'm not forced to sell those assets, or sell too many of those companies at a time when it doesn't get a chance to recover? There is planning work that needs to be done around that. But that's just a maths problem. That's just a dollars and cents thing of, okay, well, do we hold a couple of years worth of reserves in cash and, blah, blah, blah. And we've talked about all that in the past. The fundamental point that you're making here is that once I've done the planning for that, once I've allowed for the fact that that's going to happen and I know what my plan will be when that drop happens, why do I care? Why is it seen as a bad thing? It fundamentally doesn't. It does not matter those assets that you own for the next 30 years. It does not matter if you wake up tomorrow and the current going price of those assets is 50% more, 50% less. It has no bearing on your life and on your financial planning.
No, absolutely. You're spot on. I feel, because I've been on a rant, anytime we do a rant podcast, it should be a shorter podcast by its nature. So I probably don't have too much to add here.
I think you've ranted. I've now ranted in response to your rant. I think we can wrap it up.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. For more information and resources, visit the Money Over 50 website, mo50.com.au. We look forward to catching up again soon.